What's up, everyone? Well, of course, the answer is the stock market. All three major market indices are still riding record highs. Most analysts agree the driving force behind the rally is still President Donald Trump. Liberals may hate him, but Wall Street seems to love him. Specifically, they love his corporate-friendly economic and regulatory policies, and they're still optimistic that, as a businessman, he can make good on his promise of 4% annualized GDP growth. So far, though, it's still just that, a promise. We still don't have many details about just how he's going to do it or know the true potential for its success. So why is this so important in relation to the stock market rally? Simply because it means that if you're committed to riding this rally all the way to the end, you may possibly just have a lot more to lose than you have to gain. It's time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies and new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional-style investing to your portfolio. Hello, everyone, and welcome to the Income Generation. I'm David Scranton, your host, and today we're revisiting the Trump bump. It's a topic we haven't really addressed head-on since before the inauguration. Has the nature of the post-election rally changed now that the Trump administration has passed the halfway point of the first 100 days? Is this something more than a typical honeymoon between a new president and the financial markets? Is it a good idea to hang in there for a while if you haven't yet started minimizing your market risk or focusing on retirement income? Those are some extremely important questions for anyone over age 50 with money in the market. As always, we've got some great minds to help us find the answers. In just a bit, we'll talk to Jon Najarian. Later, I'll sit down with some fellow thought leaders in the financial advisory field for another edition of the Advisors Roundtable. But first, let's take a closer look at the Trump bump phenomenon. As you probably know, between Election Day and the end of February, all three major market indices hit new record highs several times. The Dow Jones Industrial Average, for example, rose from 18,332 on November 8th to 20,812 on February 28th. During that same time span, the S&P 500 climbed from 2,139 all the way to 2,363, while the NASDAQ went from 5,193 to 5,825. Those are some huge gains, as President Trump might say, but it's important to remember that the size and duration of a rally isn't always indicative of its strength, and there's certainly evidence to suggest that's true in this case. For example, hard economic data since the election has been hit and miss at best. At the same time, the 10-year Treasury yield has stabilized at just under 2.5%, which means that investors aren't really fleeing the bond market and betting only on stocks. To me, that's a clear sign that their optimism is actually cautious despite the hyped-up record highs in the stock market. But here's another important point to keep in mind about this rally. When the Dow first surpassed 21,000 on March 1st, analysts agreed that spike was a direct result of Trump's first speech to Congress one day earlier. But the speech itself didn't really contain any new details about Trump's budget, his tax plan, or his party's new version of Obamacare. Those things are all central to the success or failure of his economic goals. And we still don't know a lot about any of them. We do know the basics of the Trump tax plan. That we covered in detail on last week's show. In fact, you can watch it on the incomegeneration.com. The reality, though, is that these record-breaking highs reflect a market that is wildly irrational and overinflated, with stock values that are out of whack with current corporate growth rates. This is why I say that investors potentially have very possibly much more to lose than to gain by trying to ride this rally to the bitter end. To put it simply, the positive impact of Trump's plan has already been priced into the market, even though very little impact has yet to be felt. That means if and when we do start seeing signs that President Trump's promises are coming to fruition and positively affecting the economy, the markets probably aren't going to climb much higher than they already have because, of course, it's already priced in. They might actually have to let actual growth catch up to the lofty heights that they've already reached based upon this optimistic hoping for that growth. A good analogy is to think about your furnace. On a cold day, you might be reluctant to turn your thermostat up if you know your oil tank is almost empty. But let's say, for example, that you call the oil company and they say they're coming. Well, then you might just decide to crank the heat because you know that your oil is actually on its way. Of course, you can't know that for sure. You're just hopeful and optimistic that they're coming. But once the tank is full, you're probably not going to turn the heat up much higher, if at all, because you've already set it high based upon your optimism and confidence in your oil company delivery. So the upside of your confidence is only status quo. But what if the truck breaks down? What if there's a sudden snowstorm and it can't get to you until tomorrow? And what if turning the heat up in the advance burned your last few gallons of oil in the meantime? Well, obviously, in that case, the potential downside to your optimism ends up being much more severe than the upside was rewarding. I believe that's a similar situation with Trump's impact already being priced into the financial markets. It creates a situation with a lot more downside than upside for buy and hold investors. I'll talk a lot more about that downside potential a little later in today's show. But for now, let's bring in our first guest for our national profile. He's a man who definitely knows a thing or two about stock market ups and downs. Jon Najarian started his highly successful career as an options trader at the Chicago Board Options Exchange in 1981, and this was immediately after following a stint as a pro football player with the Chicago Bears. Jon and his brother Pete are the co-founders of OptionMonster.com, who is a provider of market intelligence, commentary, and strategies. He's a regular on CNBC's Fast Money and is always in demand as a very informed and insightful market analyst. Welcome back, Jon.
Great to be with you, David. Thanks for having me.
I don't know if you remember, last time you were on 2-3 months ago, you actually schooled me. I was concerned, if you recall, about all those Hillary Clinton supporters that were vehemently opposed to a Trump presidency who might start a major sell-off during the first 100 days because of concerns of some of Donald Trump's policies during those first 100 days. And do you remember what your response to me was when I said that?
Well, I hope it was that I thought that they'd roll back regulations and knock taxes down, which are two things the markets really like, but you tell me, Dave.
That was part of it, but what you said, kind of tongue-in-cheek, is you said, Dave, even Democrats are capitalists also. And look what's happened since then, right? The market's up nearly 15% since Election Day and so on. Janet Yellen was able to raise rates a quarter point twice now. What do you think? Do you think she's going to be able to continue raising rates 2 more times as she hopes to throughout 2017?
I think so. I think the economy is gaining some strength. I think the regulation rollback and the likelihood that we're going to see taxes decreased as well for individuals and corporates, Dave, I think those are pretty powerful drivers. And the fact that we've got housing starts highest level since 2007 today, I think that also is a significant increase in optimism for the market.
Now, you know, it's funny because it's said that the bond market is smarter than the stock market in terms of looking forward. And of course, the bond market, the yield on 10-year Treasury went up significantly right after Election Day, but it's leveled off right now. In fact, it dropped 10 basis points yesterday after Janet Yellen's announcement, which leads me to believe that it's not so much a flight from quality into risk. It's not a risk-on trade per se. It gets me concerned that maybe it's just that money that's still sitting on the sidelines from 2008. That's going everywhere. It's going into the stock market. It's going into the bond market. What are your thoughts on that?
I would agree. I think that money is looking for homes in various assets, although some of those assets are getting kind of inflated right now. So I'm focused on the ones that haven't moved as much, Dave. But yeah, I think you're exactly right. The big pop in interest rates that we saw after the election, we've never gotten higher than that over the past 2 interest rate increases. So in other words, Janet Yellen has increased 50 basis points, and we're still where we were right after the election before she moved on interest rates. Tells me the bond market got ahead of Ms. Yellen.
Yeah, and there's a chance that if there's some bad news that comes out and the 10-year goes back down 20, 30, 50 bips, it's completely possible that that alone may preclude her from being able to raise interest rates anymore for fear of flattening out the yield curve, correct?
Yeah, and we have all these elections. I mean, so far we have one that's gone the way that Europe preferred it to go, and that was it didn't go to the nationalist or the populist party, Geert Wilders over in the Netherlands. But you still have France with Ms. Le Pen, you still have Germany, and you still have various elections in Italy. So those could also be things that cause Ms. Yellen to maybe hit the pause button rather than getting more increases rapidly heading our way.
Sure. What do you think oil prices are trying to tell us right now about the economy or the financial markets? What's your take on that? That's not my specialty, so give me your take.
All right, I'll say supply and demand, Dave. So because we've got Iran back on, and even though we've had some problems in Libya and they've gone offline a little bit, nonetheless, the U.S. shale producers have ramped up production virtually every week for the last 12 or 13 weeks. And that is, quick spigot, turn it on, and that has caused there to be more supply than demand. So prices have to moderate. We've already seen that moderation. I think 49 is an area that if it holds 49 per barrel, then we can go back up over the next 3 and 6 months.
And what's your best crystal ball say about the stock market moving forward? Do you think there's more upside than downside? Do you think there's more downside than upside? What are your thoughts? Can the Trump bump still run?
Yes, Trump bump can still run. However, I think that if you give me an 18-month time frame, I'll say definitely we're higher. In the short term, there are going to be those bumps that you already addressed, Dave, that could cause either Ms. Yellen or the economy to pause. And when we hit those, I don't think we see 10% corrections, but I do think that we could go up another 7 to 10% this year. So again, with a 8 or 9 month time frame, I'd say more upside than downside.
Momentum's a powerful thing in the markets, as you well know. And we need to take a commercial break. When we come back, though, John, I want to talk to you a little bit about your area of expertise, which, of course, is the options market, and get your best take upon our return about what you think the options market is trying to tell us about the upside versus the downside, and if they're agreeing with you with that 18 months. So stick around if you don't mind, John. We have a few more minutes we'd love to spend with you here on the show. And for our viewers, you too, stay around. We'll be right back with a lot more from options legend Jon Najarian. We'll be right back.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Today, the Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point, bringing it to 3/4 to 1%. Our decision to make another gradual reduction in the amount of policy accommodation reflects the economy's continued progress toward the employment and price stability objectives assigned to us by law. The economy continues to expand at a moderate pace. Solid income gains and relatively high levels of consumer sentiment and wealth have supported household spending growth. Business investment, which was soft for much of last year, has firmed somewhat, and business sentiment is at favorable levels.
Welcome back to The Income Generation. You've just heard from Federal Reserve Chairman Janet Yellen discussing the Fed's decision to raise interest rates by just 1/4%. So for 4 months now, we've had a stock market riding on hope and optimism that President Trump will be able to do what he says he'll do. It's like big investors have set their thermostats on high with the complete confidence that the oil truck is indeed on its way. If it does arrive, they're not likely to raise the thermostat much higher. They have already priced its impact into the market, essentially burning fuel they expected will get there. But what if it doesn't get there? In other words, what if in the coming months we start seeing signs that the execution of President Trump's economic plan really isn't viable? Or what if it encounters a major setback of some kind, or simply takes much longer to implement than Wall Street was hoping for? The question becomes, could we suddenly see the optimism that's fueled this record rally turn into an equally strong feeling of pessimism? And if so, could that fuel not just a rally reversal, but start off a new major sustained market plunge? Don't forget, that plunge is already overdue according to the hard-earned lessons of stock market history. We've had just 2 major downturns in our current long-term secular bear market cycle so far. Every other secular bear market throughout history has had 3 or more, oftentimes with each one being steeper than the previous. Therefore, history tells us the next drop could be as steep as 70%, but should exceed at least 35%. Speaking of history, I couldn't help be struck by the interesting footnotes related to 2 recent Trump rally milestones. In the days leading up to President Trump's congressional address, the Dow Jones Industrial Average rose steadily for 12 straight days, creating record highs. The last time this happened was in January of 1987. But what most people remember about that year is that October 19, 1987, the stock market experienced its biggest one-day crash ever, with the Dow Jones Industrial Average losing 22 points, 22% of its value, on this day known as Black Monday. And when the Dow topped 21,000 for the first time following President Trump's speech, it marked the fastest 1,000-point run-up in the index since 1999. But when most people think of that year, however, they're more likely to remember that by the end of the year. That is, the bursting of the dot-com bubble. That's when the markets began a plunge that eventually surpassed 50%. And of course, is what I believe to be the first major drop of this current long-term secular bear market cycle. So the question becomes, I believe, for everyday investors, is with Trump's impact already priced into the market, is it really worth it to hang in there for another possible 5 or even 10% gain if it means potentially risking 35 to 70% downside in your portfolio? The question is the upside reward comparable to the downside damage? If you're a regular viewer, you may have heard me talk about this before, the imbalance between the potential payoff of an overvalued market compared to the potential price lag. I think of it like walking into a casino and finding a game that pays you $10 if you win, but costs you $30 to $35 if you lose. The question becomes, would you play that game? Hopefully not. But that's essentially what investors determined to ride this rally to the bitter end may be doing. And it's an especially risky game for investors who are retired or within 10 years of retirement. Let's face it, at that stage of life, you don't have the luxury of time to recoup a major loss. That's why protection and defensive strategies are so incredibly important. And those strategies start with risk reduction. The other thing I encourage investors near retirement to think about is whether a stock-based strategy really aligns with their retirement goals at all. I urge them to identify their goals, if they haven't yet already, to make them specific and to write them down. In fact, I find in my experience working with clients is that most goals for retirement are fairly common. People want to travel, they want to dine out more, they want to go to more plays and concerts, they want to do more golfing or fishing or whatever their passion might be. They want to spend more time with their grandchildren, spoiling their grandchildren, which sometimes requires travel. All this is great stuff, of course, and it all takes money. But the next thing that I encourage you to ask yourself is, how exactly would you prefer to pay for those goals? Would you want to have to sell investments each and every time you want to spend a day doing one of these things that you love? Or would you prefer to be able to pay for them from income? The majority of people I speak with say that they'd prefer to pay for them from income. So the next question I always ask is, well, does your answer align with your investment strategy, or perhaps are they in conflict? Odds are, if you're chasing capital gains and trying to squeeze every last dime out of an already overvalued market, it probably doesn't. But how do other financial advisors view the Trump bump? And what are they hearing from their clients about that? Now, let's bring back our national profile guest, Jon Najarian. Thanks for sticking around, John.
Great to be here, Dave.
So, again, as the person who's really known, as of late at least, as the options expert, what's the options market telling us? Is there more upside or more downside in terms of premiums on puts versus calls?
Believe it or not, the option market is saying that the markets are a little nervous. People are covering with some puts, but that's a positive thing. I mean, the actual movement, Dave, in the market has probably been about 0.4%, maybe 0.5% on an average trading day. And that means we should be seeing a VIX, or a volatility reading from the SIBO, of about 8. Instead, we're seeing 11. So what that tells me, 11 and 12, tells me that that extra 3 or 4 points that's put into the VIX is because people are protecting. That's a positive sign, rather than people saying, well, the VIX is only at 11. True, but the market's only at an 8. So when you see that, it tells you that rather than people being overly optimistic, they are somewhat cautious, and that's a positive sign, especially for contrarians like me.
That is a positive sign, you're right. When people become irrationally exuberant, that's when we all get nervous. But if you had to say, is there twice as much premium on the put side than the call side? Is it 50% more, or is it just a little bit more?
It's only a little bit more.
A little bit.
But the people are making speculative bets on the upside with call options, of course. And a lot of the big portfolio managers are snugging up a put underneath the market to act like an insurance policy in case the market makes a 6 or an 8% correction. But unlike 2008 and 2009, we're not seeing any of those big downside bets coming into the market, in particular from the hedge funds. So seems like the market's pretty calm.
Yeah, and it's interesting because our viewers, the income generation members, most of all, if they're using options, they're writing covered calls, or maybe they're buying puts to protect their downside, just as you indicated. Does that change? I'm sure you're talking about the shorter term option expirations at this point. Does that change when you go out 12 or 18 months? And if so, how and what does that tell us?
Okay, so if I push it all the way out to about September or October, where we don't get much volume past that, Dave, but in other words, out, let's call it 6 months or more, the volatility for the S&P is closer to 16 than it is to the 11 number that I detailed earlier. So again, they're saying that a little more risk the further we get out, and then once we get towards 2018, the risk drops down a little bit, and maybe that's because they think we're going to get some of that tax reform that you and I talked about at the top of the show.
I see. Okay. Great. That's great insight, John. We really appreciate you being here with us today. Our viewers very much appreciate that. If any of our viewers want any more information, they can go to Investitute.com. Again, that's Investitute.com. And when we return, Miranda Kahn will give us an update on the financial stories from this week. And after that, we'll bring in our Financial Advisors Roundtable.
Welcome back to the Income Generation. I'm Miranda Kahn with your Newsmax Finance Update. Here's a quick recap of the stories that moved the markets this week. The Federal Reserve raises its benchmark interest rate by 1/4 of 1 point due to the quickly growing U.S. economy. This is the third time the Fed has raised rates since December of 2015. Brexit is coming. Britain's Parliament tells Prime Minister Theresa May that she can file for divorce from the European Union. At the same time, the British and Scottish leaders are trading barbs over Scotland's desire to hold a vote on independence. And state officials say the Republican health care overhaul that's working its way through Congress could leave them with a very tough choice. Either find a way to pay for federal cutbacks or see millions of Americans lose their coverage. For more on these stories, visit newsmax.com/finance. I'm Miranda Kahn. Now back to David Scranton and the Income Generation.
Thanks, Miranda. Now that you're all up to date, let's bring in our Financial Advisors Roundtable. Joining me now, we have Jeff Small, the president of Arbor Financial Group. And joining us via Skype, we have Jay Carrier, my right hand of Scranton Financial Group up in the great state of Connecticut. Thank you all for joining us today.
It's great to be here, Dave.
Thank you, David.
You know, it's funny because, Janet Yellen was unable to raise interest rates through the really through the Obama administration, except for once. And of course, as I predicted after the first rate hike at the end of 2015, she'd be unlikely to be able to do it again in 2016. But all of a sudden, under a Trump presidency, it seems like the floodgates have opened up and now she can raise rates. She's done it twice already. You know, he's only been in office for a month and a half. Well, why is that?
Well, Dave, this is a really confusing issue for your viewership. The reality is we're at the end of an 8-year economic expansion with the weakest fundamentals in history and the highest asset prices. So the Fed is being dovish at this point. They're preparing us for a recession at some point in the future. And when we hear the pundits on TV talk about these issues, they're really not being totally forthcoming, because when we look at historical rate increases, there's usually some type of a recession within 11 months to 30 quarters.
So you're looking at it saying there's probably going to be a pullback at some point. They're trying to get more ammunition as backup in case they need it, is basically the bottom line.
Absolutely. They need some wiggle room to re-stimulate.
Okay. So Jay, what do you think? Do you think that we need this ammunition? Do you think that we have another pullback around the corner? Or do you think this Trump bump, as we call it, can run for a while longer? What are your best thoughts?
Well, Dave, you've talked about this in the past where we had long-term interest rates. The 10-year Treasury, for example, right before the election was about 1.5%. Now it's trading at around 2.5%. So Janet Yellen was kind of in a hole for a little while where she couldn't raise short-term interest rates because that would have flattened out the yield curve. Now that we have higher long-term interest rates creeping up now, 2.4, now they were 2.6. We've seen a little pullback in the last few days. She now has, as you call it, ammunition to raise those short-term interest rates. So that was sort of the problem, the dilemma that she was in throughout most of the Obama administration. Whether that continues, now she has that wiggle room. As she announced yesterday, there's probably going to be 2 more rate increases now here throughout 2017. So whether this continues or not, that's the gamble right now.
That's the gamble, sure. So what's interesting, though, and I don't know if you picked up on this or you picked up on it, Jeff, but you know what I saw was that yesterday, right after she made her announcement, the 10-year Treasury yield went down by 0.1%, 10 basis points. And you know, and yet the stock market, the Dow went up over 100 points. So normally, if the Dow went up, you know, that'd be due to a flight from quality, money moving out of Treasuries. The 10-year yield would have gone up, not down. So it seems to me as though what's happening is there's just still so much money sitting on the sidelines. It's flooding in the markets. It's still there from 2008 that's going in. It's not total confidence. It's kind of like 1 foot on the accelerator, 1 foot on the brake. But I guess the question, Jay, becomes, you know, what happens if that changes? What happens if all of a sudden some bad news comes out, the 10-year Treasury yield goes back down to maybe low 2s? All of a sudden now, does that foil Janet Yellen's plan to raise rates 2 more times during the year of 2017?
Yeah, absolutely. I mean, we were sitting here, you know, we talked about the Trump bump, which is all really good, positive economic news, lowering taxes both on individuals and corporations. We talked about a $1 trillion infrastructure plan. Stock market loved all of that. After the infrastructure announcement, the Dow was up 335 points the next day. So we've heard a lot of great information coming out economically. But the problem is the intangibles that Donald Trump's bringing. Is he going to tweet or say something that's going to rattle the stock market?
The famous Donald Trump tweets. Yes, of course.
Yeah.
By the way, for our viewers, I want to let you know that, I don't know if you know this or not, but how we've chosen our guests for today is that, you may not have heard this, but this is true, that March is indeed Bald is Beautiful month. Yes, the month of March, bald is beautiful. So, okay, you know, what do you think the most important thing that Donald Trump really needs to do to keep this rally going? And do you think it will go, or do you think there's more downside than upside right now in the markets, Jeff?
Well, even though we're hitting all-time peaks on a number of different stocks, Dave, there is some turbulence in the market right now. Right now, 50% of all the S&P companies are off their highs by 10%.
Sure.
And the top 1% of S&P companies are within 1 to 3% of their highs. So the top end of the market is carrying the market, so to speak. So if we don't get tax reform by August, if they don't fix the Affordable Care Act, if they don't get the right stimulus plan in place, the market will see these as signs as turbulence, and that can be a catalyst for a pullback.
And maybe that's why Jon Najarian, who was just on, of course, as you both heard, indicated that the options market is pricing a little bit more downside in the markets than upside right now. So again, that's probably having that one foot on the accelerator and one foot on the brakes. But what do you think of all those things, Jeff, politically? What's the most important thing Donald Trump could do to keep the markets happy? Is it reforming taxes? Is it deregulation? Is it infrastructure spending? You know, what's the first thing that he would have to focus on, in your opinion, to keep Wall Street happy and keep the markets moving forward?
That's a great question, Dave. And it's really what got the market started, and that is tax reform. If they can reduce corporate taxes from 35% to 20%, good luck with that. But if they can do that, that'll keep the party going.
Okay, so tax reform, put the money back in the hands of the citizens.
Correct.
Okay. Now, Jay, you know, it's funny because we had this last week, we had some guests on, and we had a little controversy going on between our financial advisors about that. And people say, you know, some people say put the hands right back in the money right back in the hands of citizens, let them have more money to spend. Other people say it's trickle down. You know, if you cut corporate tax rates, you get more money in the area of corporate America, so they can hire more people, they can invest more in infrastructure, that'll find its way down over time, and that'll be a better stimulus to the economy. Now, as someone who, in your own right, is a tax expert, what do you think is most important? Just to put it in the hands of the citizens, or to put it in the hands of corporate America so they can hire more people, create more jobs, and it'll trickle down? Your best thoughts?
That's a tough one. I'm leaning more towards the individual citizen. Okay. And let them, not only that, but also simplify it. You know, the tax code right now is very complicated. So I would say combination of simplification as well as getting in the hands of the citizens.
Okay. Now, I know you didn't say trickle down. Now, is that because you're sitting in Connecticut right now, of course, which is my home state also, a state that's fairly liberal? Is that fueling your comment at all, or would you feel, or would you be saying the same thing if you were here in studio in Florida, which is a red state?
Well, you know, the new word for trickle-down economics is free market economics, first off. So they have changed the name. And trickle-down economics really hasn't worked. I mean, there's been some experiments recently. The state of Kansas, for example, has implemented very strict trickle-down economics.
But Jay, I say, and we have these debates in the office all the time. And Jay, yes, you are my right hand. Of course, what our viewers need to know is I'm actually left-handed. But trickle-down doesn't work. Trickle-down doesn't work, Jeff, because it doesn't have time, because the president puts it in, he's out in 4 years or 8 years. In the last 20 seconds or so before we have to take a break, what do you think? Does trickle-down work, or does it not work? Do you agree with Jay? Am I the odd man out?
It's a short-term solution, but it increases the debt factor. So what we have to do, what Trump has to do, is get the velocity of money moving in our country, which means money's got to start circulating at a faster pace. And that's happening, and there is no economic gauge to measure
But
that.
trickle-down is the thing that really does that. So let's leave it there for now. We have to take a commercial break. Guests, if you could stay with us, we'd love to have you longer. And for our viewers also, please stay with us. We have a lot more from both Jay and Jeff as soon as we return. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back to The Income Generation. I'm David Scranton, your host, and we're here today with Jeff Small in studio and Jay Carrier via Skype. Jay, Jeff needs to leave us a little bit early, so I'm going to focus on Jeff for just the next few minutes here and get his words of wisdom, his pearls, before he has to go. You know, what do you think about the markets here? Do you think there's more upside potential in the markets, and if so, how much? Or do you think we're so close to the top now, it doesn't make sense riding it anymore, or trying to squeeze the last bit out of it? What are your best words of wisdom on that for our income generation viewers?
Well, especially for your viewership, Dave, I think at this point, with the market being at 52-week highs pretty much across the board for the major players in the market, it's time to really lock in some gains. And at some point, with the $3 trillion of market value that's been created the last 3 months since the election, Wall Street's going to lock in those gains. That's already started to happen with insider trading.
But with all that money on the sidelines, you know, right now we have all this money sitting on the sidelines. That's why the bond yields are coming down and the bond prices are going up, the stock prices are going up all at the same time. I know, especially down here in Florida, we see real estate prices going up like crazy again, almost like it's 2007 all over again. So, you know, with all that, though, could it be that there's so much money on the sidelines that something really bad would have to happen to derail this bull market?
Well, we never know what the catalyst is going to be. It has to be a catalyst, but there's no doubt that there's much greater chance of a 20% correction than there is a 20% advancement in asset prices at these all-time highs, Dave. We were at the second highest asset price valuation in history since the Great Depression.
You know, there's a statistic that I want to share with you recently that I learned about, that Calvin Coolidge took over office, I believe it was in 1923. And he came in with policies much like Donald Trump. He came in with policies that were very much geared toward building infrastructure, helping our trade balance become more favorable, cutting taxes, giving money back to the citizens, and deregulation. That was his platform. Sound familiar?
Very familiar.
And then that started the best bull market in U.S. history. Can that happen here?
Well, is it possible to grow the market in the second best bull market of all time with the least amount of economic growth the last 8 years at the market top? I think you need an act of financial Moses to keep the market going up from here for another 8 years. That's going to be next to impossible, no matter what happens.
So you're saying President Trump is really good, but he may not be able to walk on water quite yet. So is that what I'm hearing you say?
That's exactly what I'm saying.
Okay. Now, the other thing, too, is when you think about it, the amount of national debt, the amount of the deficit we had back in the 1920s was nothing compared to the records that we have today. So with that in mind, you know, how much of a factor do you think is the deficit, is the national debt today that makes it very difficult for President Trump to do the same thing that a President Coolidge was able to do?
Well, it's a huge factor. But going back to 1929, we had that 6-year expansion with Coolidge. We also had to print up money and borrow it from ourselves the same way we did in 2009. So we had a central banking intervention to get us out of the Depression. And we did the same thing in 2008 and 2009. So we're coming out of that now. So it's going to be very hard demographically to shift massive amounts of consumerism without dramatic expansions in credit. And we've already expanded credit to its peak. We are in a credit-facilitated stock market value right now. We are not in a productive stock market value.
If you think about it, we've been in this credit bubble. We mentioned this on a previous show. We've been in this credit bubble now for pretty much 30 years. If you go back to the invention of automobile leases back in the 1980s, people getting the mindset, gee, every 2-3 years I need to have a new car. The first liar loans were actually in the 1980s when it comes to mortgages. So that's a big part of it.
It really is, but I think the typifier for me is now that the Fed is taking an active movement in raising rates, that tells me that we are anywhere from 12 to 30 months away from the potential for a recession because they are taking a dovish approach. She said some things yesterday that were completely ignored by the massive financial media.
Yeah, no, she did. And go ahead and highlight what you think is maybe the major thing that she said that people missed.
The biggest thing is that she said that these employment numbers can't continue. And she's very concerned about global growth. And there's lots of uncertainty geopolitically. There could be trade wars. We have the rise of nationalism across the globe. We don't know if that's going to pan out in Germany and France and Italy and how those elections are going to go. Went good for the Netherlands, I guess, for the EU to stay together, so to speak, but we'll have to wait and see.
Yeah. You know, if she can get short-term interest rates up to really what's maybe 2.5% would be the target, that would be great. But again, as I asked Jay, that can only really happen if long-term rates are able to move up more. You have a flat yield curve. So are you concerned with the fact that she's going to be limited how much she can raise rates? Even though she might have some ammunition left, it may not be as much ammunition as she needs for the next economic pullback.
Well, you know, that's a very interesting question. You know, we thought the global banks were sort of working in concert so together globally for the global community economically, but if she raises rates, it completely imbalances the globe. Yeah. And, you know, that's why we've got these big problems.
Yeah, absolutely. Jeff, I know you have to go early. Thank you so much for being here today. We very much appreciate it.
Well, thank you for having me, Dave. It was great to be here.
And Jay, stick around. We'll be right back with more from the Financial Advisors Roundtable. Stay with us. This is fun. This is great. 3, 2, 1. But I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. Welcome back to The Income Generation. I'm David Scranton, your host. And rejoining us, we have Jay Carrier, my right hand from Scranton Financial Group in the great state of Connecticut. Jay, thanks for your patience as we spent some time with Jeff over the last few minutes.
Sure, absolutely.
You know, it's funny, you always get, it seems like the short end of the stick around here because in our office, we always have great, intelligent water cooler conversations between the two of us. You're one of the sharpest guys I know in the financial field, but because I'm the television hog, you just don't get too much screen time. So I'd like to ask you, what are your thoughts about what Jeff just said? Do you agree with some of the things about the dovish comments that Jenny Yellen made? Do you share the same concerns? Or are you a bit more optimistic, a bit more pessimistic? Give me your thoughts after yesterday.
Yeah. Well, going back to one comment or a question that you asked Jeff and Jeff answered, and I agree that what's the next thing that Trump needs to do in order to keep this bull market going? And Jeff had mentioned tax reform, and I agree that is going to be a big one. But really, it's getting something passed at this point.
Right.
Now he's only 50 or so. Yeah, he's only 50 or so days into his presidency, so he has a long ways to go. But he's working on the Affordable Care Act, repeal and replace. But yet, all of these wonderful things that he's talked about, none of those things have been passed yet. And so I think that's his issue, is having to deal with Congress, the Senate, and this isn't a monarchy. He does have to work with other people in order to get his economic policies pushed forward.
Yeah, and I know, we work primarily with people who are retired or close to retirement. So for our clients, it generally doesn't make sense to try to squeeze 10% more out of the market. But what would you say about somebody who's younger, who's more aggressive? Do you think it makes sense for them to try to squeeze a little bit more out? Because, let's face it, this momentum can be powerful. You know that as well as I do. Markets tend to go up further than we think and down further than we think. What if somebody can afford to take the risk? Do you think there's enough more upside to make it worthwhile?
Well, I'm under the camp. I don't take, and you are as well. You don't take risk if you don't think you're going to be rewarded. Certainly, if someone is contributing to an asset through dollar cost averaging, then that might be a little different circumstance. But for the most part, no. I don't think the upside is there enough for really anybody to take the risk. I don't care if they're a newborn or if they're 90 years old. Don't take a risk in which you don't think you're going to be rewarded.
That's right. Even a 21-year-old investor doesn't want to deal with another downturn in the market and recovery that takes 6 or 7 years to drop and recover like the last. Even a 21-year-old doesn't want to get zero return for 6 or 7 years. So, and it's interesting when Jon Najarian said that the options market is pricing in more downside than upside. That was surprising. As you know, that's unusual. But Jay, stick around. We need you for just a bit longer. I hope you're not too busy. You have a minute for us. Stick around. We'll be right back. And for Income Generation viewers, you stick around too. We have many more words of wisdom for my right hand. Jay Carrier will be right back. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back to The Income Generation. I'm David Scranton, your host. Now let's bring back Jay Carrier to finish this out today. Jay, I agree with you. People don't want to take risks for which there's potentially no reward. But you and I were surprised by this whole 12-15% market recovery. So is there anything new in your research that you found that would lead you to be bearish, that would lead you to say, the market really truly is overvalued? Something that we haven't talked about since I was with you in Connecticut last week.
Yeah, right here in our backyard, Robert Shiller, his capital asset price to earnings ratio has now flipped. He's gone from a buy index now down to a sell. So, another kind of economic indicator showing that now there's some sell signals here in the stock market.
So you're saying that just because Robert Shiller is professor emeritus at Yale, that he's a pretty smart guy. Is that what I'm hearing you say?
Yeah, not too bad, not too shabby down here.
And get our research right from 20 minutes down the street. I agree completely. Well, that's great, Jay, and thank you so much for your words of wisdom as usual. We appreciate you being here and being part of our Bald is Beautiful month. And I promise I'm going to try not to be as much of a television hog. We'll get you a little bit more airtime in the future.
I appreciate it, David. Thank you very much.
Oh, you're welcome. Good having you, bud. Before we go, I'd like to thank Jon Najarian as well as this week's guest advisors. I'd also like to thank all of you, our new and returning viewers. I hope we help put the Trump bump into perspective for you today. The hype around any market rally can be confusing and often conflicting. It's hard to sort out the hype from the real facts and information, which is why we devote this entire show to this particular topic. There's more than enough hype on all those other shows. We don't want to give you any more here. And hopefully you understand now why this rally can be deceptive in many, many ways, and why you may have much more to lose than to gain by trying to ride it out to the bitter end, especially if you're retired or within 10 years of retirement. And hopefully you've taken some time to think about your own retirement goals and whether or not they really align with your financial strategies. If not, I strongly encourage you to do so. I'm David Scranton, and thanks for watching The Income Generation.